This first slide I put together, this was before California. So talking about the insurance market today and why we're seeing what we're seeing, a lot of things factor into it. There's the national scale, there's regional, and then local issues as well. This is just a graphic from 2023. These are all the individual billion-dollar insurance events that happened across the country. It was 25 separate events. This was the most we've ever seen in any given year. 2024 had a handful, not as many as 2023, and 2025 is not off to a great start with California. Most of the data that we're seeing on the news, they're expecting that to exceed over $50 billion in damages. So as insurance is a shared pool of risk between everybody, it will affect Minnesota in one way, shape, or form. What we've seen so far, wrapping up 2024 and starting with 2025, has not been positive. American Family has non-renewed or is starting to non-renew the rest of their associations. So American Family at one point had over 70% of the HOA market share. Over the last few years, they've been trying to get rid of most of their associations as it has been an extremely unprofitable business for them. The few that are remaining on their books are the difficult ones. And so they are still with American Family because they haven't been able to find another carrier to take them over. As of January 1st, American Family will be non-renewing all the rest of their associations. So if you are still with American Family, this will be your last year. Most associations that we are seeing leaving American Family are facing significant increases, 100% to 200% in most cases. Country Financial, a smaller player in the HOA space, but still writes a handful of associations, specifically the smaller and older associations, which also have a lot of issues finding new carriers. They've also announced that as of January 1st, they will be non-renewing their entire portfolio in Minnesota as well, which there's one that didn't make it on here, just recently announced Berkshire Hathaway Guard. So there's two different Berkshire companies that operate in Minnesota, Berkshire Home State and then Berkshire Guard, also known as AmGuard. They are non-renewing their portfolio as of January 1st as well. Outside of that lovely news, State Auto, one of our more competitive HOA carriers, has been purchased by Liberty Mutual, now making them the largest insurer on the independent side. They will no longer be writing associations under the State Auto banner. So losing one of our most competitive carriers on top of all that. So what we've seen from the other carriers that remain has been a knee-jerk reaction. When you see carriers getting out of the business and you still remain in it, a lot of carriers are asking themselves, are they missing something that everybody else knows and they do not? So we've seen carriers pull back dramatically on what they've been willing to write. We've seen them increase pricing, increase deductibles, all of which you've probably seen. And then change their underwriting guidelines. So the two biggest issues that we're having right now is that the carriers that remain, which are very few, have changed their underwriting guidelines based on two specific things. So it has been on the year built and the size of the association. So most carriers will no longer write anything built prior to 1990. Some association carriers, like Auto Owners, for example, will only go back 15 years. So they only go back to 2010. Some cut off at 25 years, other 30. But 1990 seems to be the major cutoff right now where no carrier is interested in writing anything built before 1990. The reason being is just the data says that the older properties perform worse than the newer properties. As your systems become older, your HVAC, your electrical, as your water heater becomes older, we start to have more claims. And so carriers have just gathered the data and simply said older associations perform worse, and so we are no longer going to be writing them. The size of the association has become a very important piece, almost more problematic than the age, as carriers used to covet larger properties. Now they shy away from them. And so just simply based on larger properties have larger exposure to wind hail claims, more asphalt shingles, more vinyl siding, whatever it may be, the larger properties can be a larger payout for carriers. And so for properties that used to be sought after, it's completely flipped, and now carriers want nothing to do with larger properties. Each carrier has their own size on what they consider larger. Badger Mutual, for example, cuts it off at $5 million. So they don't want many associations. If they wanted it, it's extremely small. Most other association carriers will cut off at the 25 to 30 million mark. Once you go over 30 million, it becomes extremely difficult to find a carrier that's willing to even offer coverage. The claims history, first and foremost, that's what the underwriter wants to see. If they're willing to offer a quote, they want to see how you've performed for other insurance carriers. If other insurance carriers made money or lost money on you the last few years. What they're looking for are two things: frequency and severity issues. So if you've had $1 million hail claim or a $500,000 fire, that's judged a certain way. If you've had 4 or 5 small water claims, $10,000, $15,000, $20,000, that's also viewed a different way. Both are negative, but if you've had 4 or 5 small claims, they're worried that the next one's going to be the big one, and so they're probably not interested in offering a quote. If it's larger, it depends on the carrier. Some carriers, even though it's hail and it's nothing you can control, they automatically decline to offer a quote just simply because you've had a large claim in the past 5 years. Other carriers view that as a positive. If American Family bought you a new roof, you got a brand new roof, they'll gladly accept your association with the new shingle. So it really depends on the carrier. A lot of carriers are now measuring the size of the roofs, and depending on their little formula, they may or may not offer a quote. And so you may fit the age and the size, but because of the style of your home, so specifically one-story homes typically have a wider footprint, so more shingles. A carrier might not be interested in offering a quote to your association because they think you just simply have too many shingles that they don't want to replace in the event of a storm. So carriers are actually using aerial footage to measure the roofs and make sure it fits into their parameters before offering a quote. They're also looking at vulnerable siding types. So if you have a brick exterior and your neighboring building has vinyl siding, there's a better chance that you get a quote versus the vinyl siding. Again, hail has been the main reason that Minnesota has had issues, and so they're looking at what type of potential hail damage your building could suffer. Lack of grilling enforcement. I already talked to someone in the hall about this morning. If you guys haven't dealt with it yet, you will be. It is a thorn in all of our sides. Every carrier seems to be rolling out their own version of grilling enforcement. This was never a problem for the last 100 years in insurance. 2-3 years ago, they decided that they just absolutely hate grills and everyone's going to take a stand against them. Most carriers' language says something to the effect of the grills need to be 10 feet away. Some of the carriers, that's well in use. Some carriers don't allow them on decks. Some don't allow them to be stored close to the home, but used at 10 feet. The most annoying part of all of this is that there is no one rule. They don't follow city, county guidelines. Every carrier has their own rules, and they're all slightly different. So you could put a grilling rule in place today for your carrier, and then next year when you want to find a new carrier, they've got a slightly different rule. All right, I figured grilling would get some questions, so we can circle back if needed. All that to say, there's difficulty obtaining multiple quotes right now. So there's a couple property management companies that still have old language in their agreements that say they'll get 3 insurance bids every year. It's almost impossible these days to get 3 insurance bids, depending on your age, your size, your claims history, grills, roofing, etc. So
I get lucky to get 1.
Yeah, a lot of times you're lucky to get 1, maybe 2. Occasionally we'll be asked that we have to put 3 on there. The third one is like 3 or 4 times more expensive, so you're just checking a box to meet the agreement. Having a renewal is probably your first major step in an insurance. Making sure you actually get a renewal is your first win. The second is if you get an additional quote to compare to. If you're getting 2 and you've got a renewal and 2 other quotes to review, so essentially 3 options, I would consider yourself very lucky in today's market. So these are just 2 quick examples, cause for concern. So you have an HOA that was built in prior to 1990 and has over $20 million in building value. CAU, Berkshire, and Berkeley are your only 3 carriers. So before anyone looks at anything else, you got 3 carriers. If you have an HOA that's over $75 million, you have CAU and auto owners. Auto owners only goes back to 2010, so if you're built in 2004, you've got 1 carrier. So you can see how quickly it becomes problematic to find multiple carriers. Non-admitted carriers. The things that typically come worse with them have been higher premiums, worse terms. They make you pay in full, which most associations can't pay that lump sum. So you have to do a finance agreement, which is an additional charge. They typically know you don't want to be with them, so you have minimum earned premiums, which means you can't leave them for 3 or 4 months. So if a new carrier came in and found something way better for you, you're stuck with them for 3 or 4 months. After that, there's a short-term cancellation penalty. They typically charge you 10% of what is left on the premium. So if you've been with them for 6 months and you still owe 30 grand, they'll charge you $3,000 on your way out because they can. And then condensed time frame. So you probably found this out on your renewal. Typically, the non-standard side doesn't get quotes out till like a week or 2 before renewal, where standard carriers, we're seeing them. We used to see them at 60 days. Then it was 45, 30. Now we're probably down to like the 20, 30 day mark before renewal. The non-standard side, depending on why you're going non-standard, can be down to the last few hours. So it's an odd market because they can do whatever they want. Typically you see it last second. This is the worst slide of the day. What you can expect to see on your renewal. So if you're with a standard carrier expecting to get a renewal, we're seeing averages of 35 to 45% rate increases. Some are 10%, some are 70%. It's all over the board depending on the carrier. And then the non-admitted side. So if you are with American Family or Country Financial, Berkshire Guard, you're getting non-renewed and you're going to be one of those older or larger associations, we're seeing 150 to 200% on average for those associations that are getting dropped by their carrier and going to the non-standard side. This has become my biggest nightmare because there's no options out there. Every agent's stepping on each other's toes. So with 2, 3 options for every association, the board and sometimes the management company thinks we need all hands on deck. Let's call 10 agents, get them all involved. That will ensure us to find the best option, when in turn that's probably the exact opposite. And so the way our industry works, only one agent can go to a carrier. So if you call me first and I go to Travelers and Hartford and Auto Owners, and then you call the guy down the street next and ask him to look at things, when he goes to Travelers, Hartford, and Auto Owners, they'll say, sorry, someone's already quoted this, you can't quote it. So when you get 4 or 5 agents in the mix, they're all going to the same carriers because there's only 2 or 3 options left. And then it turns into this BOR, AOR, which is a broker of record or agency of record. So if an agent doesn't have any options, they'll come back to the board and say, we're blocked. Can you sign this transfer form? And essentially what it is just taking the other person's homework. So if we did a quote with State Farm or Travelers, they would just take it over wherever we are. If our underwriter already approved it, it's ready to go, they'll just give it to that agent. And vice versa. We'll have boards come to us and say, we've got a guy working on it. We don't think he's doing a good job. Can you take it over? And we essentially just take whatever they're working on and take it from them. So it's become a very contentious point in our industry of the few agents that do HOAs only have a few options. And so there's all this agent of record, broker of record going back and forth. So the point I bring this up is that although it seems counterintuitive, the best way to handle your renewal is to pick one person that's really good at it, ask them what carriers they're going to go to, have them explain why those carriers make sense, and then stick with that person. Having 4 or 5 people go out typically slows down the process and makes it more convoluted. I have one today that we were supposed to get it approved last week, but then another agent jumped in, and now they're not going to approve it until each agent goes back to the board and has the board decide who they're going to use. And so it delayed the process by 6 or 7 days because more people are involved. So it's counterintuitive, but find one person or 2 and tell them who they're each going to so they're not stepping on each other's toes and wasting your time. This is a big one that I'll try to cover quick. Lender issues. So Fannie, Freddie, and FHA, who do about 80% of the loans in the country, have a rule that your wind, hail deductible or any deductible cannot be more than 5% of the building value. It's really a problem in Minnesota and Colorado currently, where wind, hail events have been our biggest issue. There are certain carriers, CAU, which is one of them, that is willing to quote basically anything. requires a 10% wind hail deductible in Minnesota. So not only is that a huge deductible, but it's not compliant, which means that anyone in your association that's looking to sell can't sell to anyone that's getting financing. They have to sell to a cash buyer or someone with alternative financing, which becomes extremely problematic. If you have a unit owner that's trying to sell and can't, you will hear about it as a board. We have realtors and lenders coming to our office and screaming at our staff to change things because their closing's falling through. We have no control over it. And a lot of times the 10% deductible is cheaper. And so as a board, your decision is stuck between a rock and a hard place. Take a less expensive option so you can keep your dues down, but no one can sell their home or refinance. So it's a huge problem. There is an exception, just doesn't apply to Minnesota yet. It says that if the deductible is geographically specific, all you have to do is get an HO6 policy that covers it. Hail in Minnesota is not considered geographically specific yet. This rolled out last February, so we're going on a year now. We've been battling it. Sean, the state legislative, has been talking about it. CAI National has been talking about it, but it's the government, so it takes a really long time to get anything done. What to do? We'll go over this quickly. Increasing deductibles. If you haven't already been forced to take deductibles higher than you would like, increasing deductibles is one of the easy ways to reduce premium. It does move the needle, sometimes not as much as you would like, but I would never recommend going over a $50,000 deductible and then 5% on wind hail for why I just mentioned, because then it makes your life difficult with lenders. Changing the coverage definition. So most of you in here are in a townhome, not a condo. So a condo high-rise building, almost all of them have a bare walls coverage definition. Townhome associations have traditionally been an all-in coverage definition or original specifications, which means the master policy covers the interior of the unit. And so as we're seeing insurance become more problematic, and that certain carriers cut off at a specific dollar amount, a lot of associations are considering moving to bare walls. It typically reduces about 20% of your building value because you're no longer covering the inside of the home. So flooring, cabinets, countertops, fixtures, etc. You remove all of that from the master policy, that becomes the homeowner responsibility. They cover it on their HO6 policy. Pretty simple, as long as everyone follows along and does what they're supposed to. What that can do, well, one, it reduces the building value by 20%, which reduces your premium by 20%. And then occasionally it gets you right under that magic number. So if you're at $33 million and you switch to bare walls, now all of a sudden you're at $27 million and you're eligible for 2 or 3 more carriers. So from every attorney that we've talked to and these presentations that we've done, most attorneys say this takes 4 to 6 months to do. So this is not something to do right before your renewal as a last minute, let's try to save money. This is a conversation to have now with your property manager and with your attorney to start working on this and making it an option if you want to do it down the road, because it does require member vote, has to go to the mortgage companies. It takes a while to get done. But this is the thing that moves the needle more than anything, is moving to bare walls. These are 2 ideas that we don't like, but that get brought up commonly. So split the community over more than one carrier. They say, we're $40 million association. Why doesn't Travelers do half and Hartford does half? Carriers don't want to do that, plain and simple. So in theory, yes, it could work, but the carriers are just not willing to do it at this point. And then the other is make the homeowners hold their own insurance. So we've seen a few associations do this. You've got 4 units in a building. Each person insures their 4th of the building. You have 4 different carriers. If you have a fire, you have 4 different adjusters on one building, one fire. It becomes extremely problematic. The individual insurance space isn't in a much better position either. So we ask board members, if they are considering this, go get a quote, and you'll typically find that if you take the single family premium, which is usually $2,000 to $2,500, multiply that by however many units you have, it typically ends up being more expensive than your HOA master policy anyway.